There's a company that owns your apartment building. You've never heard of them. They're not local. They don't have a website you'd recognize. And last month, they raised your rent by $200 using software that talks to your neighbor's landlord's software. You probably thought your rent went up because of supply and demand. That's what everyone thinks. But there's a different game being played now, and it's being played with algorithms you can't see, by companies you can't name, using a business model that Wall Street invented in 2008. This is the story of how your rent became a financial product and why that changes everything. Let's start with a number. The median rent in America has increased 43% since 2019, not over a decade, 5 years. In some cities, it's worse. Phoenix, up 57%. Miami, up 62%. Austin had a period where rents were climbing so fast, the city council held emergency meetings, and then everyone blamed remote workers and inflation and Californians moving to Texas. But here's what doesn't add up. In 2022, rent growth suddenly slowed. In some markets, it even dropped, not because more housing got built, not because demand disappeared, but because something else changed in the background. You want to know what changed? A handful of property management companies stopped using the same pricing software at the same time. We'll come back to that. First, you need to understand what happened to your apartment building. Rewind to 2008. The financial crisis hits. Millions of people lose their homes, foreclosures everywhere, housing prices collapse, and Wall Street looks at all those empty houses and has an idea. What if we buy them? Not to flip, not to develop, but to rent. This had never been done at scale before. Institutional investors, the big money, didn't own single-family homes or apartment buildings in bulk. Real estate was fragmented. Local landlords, small operators, people who owned a duplex or a 4-unit building. But Wall Street saw something else. They saw recurring revenue, predictable cash flow, an asset class that could be securitized, packaged, and sold to pension funds and sovereign wealth funds. So they started buying. Blackstone, Starwood, Colony Capital. They created companies with names like Invitation Homes and American Homes for Rent. Between 2011 and 2017, institutional investors spent tens of billions of dollars buying hundreds of thousands of rental units. And here's the thing, when you own 500 units in a city instead of 5, you stop acting like a landlord. You start acting like a portfolio manager. This is where it gets weird. When you're managing hundreds of properties, you don't set rent the old way. You don't look at comparable listings and gut feel your way to a price. You use software, revenue management software, the same kind of algorithm that sets hotel prices and airline ticket costs. One company dominates this space. It's called realpage. They have a product called YieldStar, and by some estimates, it's used to set rents for millions of apartment units across the country. Here's how it works. Landlords feed their data into the system: lease renewal rates, vacancy rates, how much rent they're currently charging. RealPage pools all this data together. Then the algorithm suggests a rent price, not based on just your building, based on everyone's buildings. The software tells landlords to keep units empty longer if it means getting higher rent. It discourages discounting. It pushes rent increases even when vacancy is rising. Now, here's the uncomfortable part. When competing landlords in the same city all use the same software, fed by the same data, suggesting the same strategies, something strange happens. Prices don't compete anymore. They coordinate, not because of a handshake deal in a back room, because of an algorithm in the cloud. The Department of Justice noticed. In 2022, they opened an investigation. They started asking whether RealPage's software amounts to price fixing. Several state attorneys general joined in. Lawsuits got filed. Some property managers quietly stopped using the software, and that's when rent growth slowed. Let's talk about what this actually costs you. Say your rent is $2,000 a month. It feels like a lot, but it's a personal problem. Your budget, your city, your choices. But if algorithmic pricing is inflating rents by even 5 to 10% across a region, that's $100 to $200 a month you're paying because of software collusion. That's $1,200 to $2,400 a year. Over a 5-year lease cycle, that's $6,000 to $12,000. Multiply that by the millions of people renting in markets where this software is deployed, and you're looking at billions of dollars in excess rent extraction. And here's the kicker. That money doesn't go into building new housing. It doesn't improve maintenance. It flows to investors as yield. It gets distributed to shareholders, some of whom are pension funds and endowments, sure, but a lot of it goes to private equity firms, optimizing for double-digit returns. Your rent became a financial instrument, and financial instruments get optimized for profit, not affordability. RealPage and the landlords say this is all overblown. They argue the software just helps landlords make better decisions, that it's not price fixing because landlords aren't required to follow the suggestions. They can override the algorithm anytime, which is technically true. But here's what the data shows. Landlords follow the algorithm's recommendations more than 90% of the time, because that's the whole point. You pay for the software because it works, because it increases revenue. There's also the argument that this is just supply and demand. Not enough housing gets built, so prices go up. And yes, housing supply is a huge problem. Zoning restrictions, NIMBY politics, construction costs, all real. But here's the thing, algorithmic pricing doesn't just respond to supply and demand. It manipulates it. The software explicitly tells landlords to accept higher vacancy rates in exchange for higher rent. That's not a market clearing. That's a market manipulation. It's the difference between prices rising because of scarcity and prices rising because someone's controlling the valve. So, what happens next? The legal cases will take years. Some will settle, some might go to trial. RealPage might lose. They might win. Other software companies might emerge with slightly different models that dodge the legal scrutiny. But the bigger shift isn't going away. Institutional ownership of rental housing is now a permanent feature of the American economy. Private equity figured out that housing is a great asset class. Steady income, tax advantages, inflation protection. They're not selling, which means the incentives have changed. When your landlord is a local guy who owns 3 buildings, he wants to keep tenants happy and avoid vacancies. When your landlord is a REIT with fiduciary duty to shareholders, the calculus is different. Maximize revenue per door, optimize occupancy costs, raise rents to market rate or above, and the software makes that easy, easier than ever before. You don't have to be the bad guy. You just follow the algorithm. This is already spreading beyond apartments, single-family rentals, student housing, even mobile home parks, where investors buy the land, trap residents who own their homes but not the ground underneath them, and then raise lot fees every year. The model works. From an investor's perspective, it works beautifully. Here's the thing nobody wants to say out loud. This might not be illegal. Price fixing requires coordination, explicit agreement, a conspiracy. But if the conspiracy is just everyone buying the same software and feeding it the same data, is that coordination or just technology? The courts will decide. But even if RealPage loses, even if algorithmic pricing gets regulated, the underlying problem remains. Housing is now an asset class, optimized for yield, and you can't optimize for yield and affordability at the same time. One of those has to lose. Right now, affordability is losing. You probably opened this video thinking your rent was going up because of supply and demand, and maybe that's part of it. But the other part, the part that doesn't show up in the news, is that your housing cost is being set by an algorithm designed to extract maximum revenue from you and everyone in your building and every building in your neighborhood. And the people who own that algorithm, they're not even in your city. So next time your lease renewal notice shows up with another rent increase, ask yourself, is this the market or is this the software? Because chances are you'll never know the difference.